I am that guy on page 2. I think the photograph was taken before I left for the Middle East about 5 years ago. And as Adrian says, I report into the executive board, and I'm the managing director of the international division. I've been with the company for about 29 years now. I worked for them as a student on the M54 motorway in '82, and then joined them after graduation from Newcastle University in civil engineering in 1984. And prior to moving overseas in 2008, I was looking after the UK regional building business. So that's a little bit about me. Wrong way. So what's our geographic reach? I'm going to briefly talk you through today what we do in the Middle East and how the business is changing as we work towards 2015. Can you hear me all right, by the way? Yeah. We operate through 13 separate businesses. We have about 22,000 staff and operatives in our businesses over there. Last year, we turned over a slightly reduced figure of about £500 million equivalent, of which our share was about 50%. So we operate in Oman, which is in pink at the bottom, UAE, which is in the sort of crook of the Gulf there, and Qatar. First of all, I just have a quick look at some of the macroeconomic issues in the Middle East. It's suffered its own setbacks in the global financial crisis over the last few years, but I think its drivers going forward are really quite different from those of the UK and the West. Much government revenue and spending is supported by oil prices, which are generally predicted to remain stable at or just below about $100 per barrel over the next few years. Though there is an acknowledgement that the oil money won't last forever, and a drive by governments to develop their economies away from dependence on these revenues, and there's quite a lot of spending in that direction. Population growth is faster than in the West, and this in turn creates the need to develop the jobs and infrastructure to support that population. Typically, I think the UK is about 0.5% growth at the moment, whereas in the Middle East the range goes from about 2 to 6%, with in some countries half of the population below the age of 25 years of age. In fact, in Saudi, I think it's half the population below 14 years of age. So there's a lot of rapid urbanisation going on. The Arab Spring has sort of generated a realisation in the sort of ruling classes that they haven't got a divine right to be there, and has resulted in an opening of the purse strings and spending on housing, infrastructure, education, and social care, as well as bringing in various sort of safeguards in terms of employment and welfare. And I think the Middle East is actually positioned very, very well as economic might shifts from the West towards the East. What also has damaged Egypt, Libya, Iraq, and Iran has benefited some of the more stable nations, which we are fortunate enough to be operating in, as people and funds flood in to the safe havens. So I think all of this is going to mean that we see an earlier upturn in our marketplaces, which I think we're beginning to see. Just a comparison of how things are done in the Middle East compared to the West. Certainly, at the moment, procurement routes are more traditional. It's a price competition, though we have certain selected clients who come to us and just say, we want it done. We have done in the past. That subsided between 9 and 11, we're starting to see it again, particularly in the UAE. They want it now. But we're also taking more enlightened forms of procurement to clients, and we're starting to get some decent pickup on that. Power is centralised and quite autocratic. They're what we might call benign dictatorships. Company ownership is very much slanted towards local patronage and partnerships with, if you want to be an inward investor. There's a lot of state-sponsored enterprise. So in the West, it's regulated and it's kept very separate. In the Middle East, that's not the case. So the airlines, the ports, the hotels, the shopping centres are largely developed by quasi-state developers and bodies, and that drives a lot of revenue into the government as well. They have an advantage of cheap fuel and electricity and water. The tax regime is low, so low corporate and personal tax. Labour tends to be drawn from the most advantageous source in terms of cost, skill, and availability. So it's attraction cost rather than equal pay. And also there's very tight visa control. So we're lucky enough to have 22,000 people with visas in the Gulf, and a lot of the new entrants are struggling with being able to get resource and build it up to do the work that they're trying to win. And business is quite stratified. You tend to find that the sort of blue-collar positions are filled largely by the labour and staff from the subcontinent. Senior management tiers tend to be staffed by Western staff, and then right at the top there'll be an Emirati or an Omani or a Qatari. The other thing, which in fact Lord Adonis referred to, is that over here things can get stuck in the mire quite a lot. In the Middle East, execution of vision is unburdened by red tape. So if they want to do it, they clear their way and they do it. So it's a lot more happening. So that's a little bit on East versus West. Sorry, wrong way again. Back in 2007, we had no. We were all construction. We had no support services businesses at all. That changed when we acquired Medina. And by 2010, you can see there that something around about 15 or 20% of our profit was coming from support services. With the startup of support services businesses in the UAE, and in fact facilities business in Qatar, and a small operation in Oman, that's now approaching about 20 to 25% of our profit. And our ambition actually is to drive that forward to become about 40% of our profit by 2015. And that will help to sort of balance our portfolio and our revenues between what is being built and what is already built, and providing services to those sort of two parts of the economy. I'll get it right in a minute. Again, when I arrived, 2008, UAE and Qatar were pretty evenly matched in terms of their contribution to our profits. 2008-9, UAE was hit quite severely by the property crash in Dubai, and Qatar became, by far the largest contributor to our returns. 2012, that's starting to come back a bit. 2015, and that's got TOCO in it, which we'll talk about in a minute. Oman is coming through, and UAE is starting to contribute more too. So Qatar becomes a sort of about 50% of our total profit, with KSA starting to kick something in, and I'll talk about that in a little while too. I'll let you read that, but you can see that all our initial investments, and we've been in the Gulf for over 30 years. Sorry if your slides are the wrong way around, mine were too. We're in the construction sector, and since 2000, How United Services is actually sort of in a state of changing the balance of its business. It was started up as a mechanical electrical services business. We've actually used that vehicle to start a support services operation in the country. MEP is at the core of hard services in FM, and that's starting to sort of change the work mix in-house. So I've moved it across. It may not be that way in some of the reports that you've seen. Medina 2007, Occupational Training Institute in Oman in 2010, and that will join up with TOCO to start to replicate what we've got in Qatar. And Kansab Group, which was a new startup FM business in the UAE. We've not ignored our construction business. We've continued to invest in it. We've not issued 100% dividends. We've reinvested in it, and I'll talk about that in a minute. So I'm going to cover construction, and then I'm going to go on and talk a little bit about support services. Oh, sorry. I'm going to do it again. I knew I would. Right side. So where are we at the moment? Well, the market is still pretty tight in all three countries of operation. But our strategy has been to hold our nerve, avoid diving in and taking low margin and high risk work, and ensure that we maintain our core strengths and capabilities, and wait for the upturn. I think that the UAE is set to recover first. We can see that there is a marked pickup in workload in our businesses there. Qatar will recover soon, but at the moment there's too many new entrants in the market, and they're depressing prices. We don't think they've got the ability to deliver, so I think there'll be a shake-up in the next 18 to 24 months. There are a lot of we've got a lot of new friends. They know that we've got thousands of men in the country, and we've got internal supply capability, and everybody wants to joint venture with us. So we're being selective about who we talk to. We think that our chance will come in the next couple of years. Oman remains competitive. Now, I would say I think in time we'll look back at the slowdown in 2008 as a good thing. It's given us a chance to step off the merry-go-round of building more and more hotels and shopping centres and palaces, and given us a golden opportunity to look forward and look at the bigger picture and where the market's going to go. So, how was the market going to change? How is it going to change? And how do we need to change to take best advantage of it? And we've been through these strategic exercises with all of our businesses, and we already look quite different. If you sort of step back from the sort of broad cross section of our businesses, construction was going to remain quite tough, margins quite tight for a few years to come. We're getting good margins in our engineering services business, and we've demonstrated that good margins are available in our facility services businesses as well. So we need to invest in those two, and our specialist businesses within the construction companies are also capable of producing better margins. So we've been investing in those as well. We've strengthened, we've reorganised our teams. We've taken the opportunity to identify big hitters in the market who've become available because of troubles elsewhere, and we've recruited them. We've spent a lot of time looking at internal efficiencies so that we can operate at a competitive level and return good margins. our traditional overtime scheme, has been replaced with productivity schemes. We've opened up new procurement routes and developed our internal supply chain. So by that, we've opened up a procurement office in China. That at the moment is supplying our CanSab businesses, and it's our intention to open that up to our other businesses as well, and even the UK. We've proven the concept. We've actually had it open. We had a guy over there procuring for us for about 18 months now, and we're actually formally registering the business now. We've proved the concept. And our internal supply chain not only is able to operate and engage directly with external clients, but also help us to deliver. And as the market starts to heat up again, I think that'll be a key differentiator. Just a quick flavour of the sort of things we do. This is CanSab operating in the UAE. That's Dubai and Abu Dhabi and the other Emirates. Top left there is a job we're doing for Miras, which is an offshoot of the engineer's office, which is Sheikh Mohammed's entity. This is a site just short of a kilometre long, and this is I want it tomorrow sort of scheme. There's a full car park covering the whole plot underneath it. It's about 350 metres right to left, and a kilometre long end to end. And then we've got 20 separate buildings to put on there to form a sort of a village next to the beach at Jumeirah Beach Residences. We started it in November last year, and the Sheikh wants it finished for October this year. So a very, very rapid scheme, and we got that on a 2-stage tender. Top right, not a very good photograph, but that's Alpha Jan, which our roads business is putting all the infrastructure and roads into. It's about 500 million. The one on the left started at 280. It's going to be considerably more than that by the time we finish. Bottom left, just an example of the sort of work we're doing with our new FM business. That's a man on one of our road sweeping machines at the St. Regis Hotel up in Abu Dhabi. And that's for TDIC. We also fitted the whole hotel and the apartments out with our specialist divisions. Bottom right, the new extension to the Ritz-Carlton in Dubai. We built that and we fitted it out with our specialist interiors business. Oman, a relatively smaller operation, turning over about 35 to 40 million Omani reals per annum. Top left, Sohar Courts. We finished that about 18 months ago, value about 8 million reals. They still haven't moved into it. Top right, actually two commercial buildings we put up in Muscat for separate customers. The one on the right is Al Sukri. The one on the left is Oman Residence, which was built for a Qatari sovereign wealth fund body. Bottom left, it is very, very difficult to take a picture that really shows you the scale of SUR IPP. We're doing all the civils on it, including the seawater intakes, which were massive holes within 20 metres of the sea. We've put tens of thousands of cubic metres of concrete and steel in there. Really, really good job, and it'll do well too. That's really our core strength, operating in the interior in Oman and doing civils, heavy civils jobs. And over the last 3 or 4 years, we've grown quite a successful interior fit-out business, which is going to need a bit of investment to keep it growing over the next few years. Done it again. Gulf contracting in Qatar. just a flavour of the sort of work it does. It's got within its business divisions, just like Cansab, so it's got a main contracting business. We've started up a new fit-out business called Interspace. No guessing how we came up with that name. Our new acquisition, Almanjara and Norco Joinery, and Spacemaker, which is into lightweight modular building. So there's kind of a sample of everything we do up there. Top left is the Barzan scheme. We're doing that for JGC, value about 270 million reals. That's on site at the moment. Top right is actually for the same customer, and that was a Spacemaker contract. These are the temporary offices, and you can see how impressive they look. They're much more than porter cabins. And what we're actually doing is selling bottom left, which is the Bionest, which Adrian and Tim have been talking about earlier, into that scheme, because it's absolutely ideal for temporary establishments. And these things are locatable, so you could, if everybody knows Agreco and what they do with generators, you can do exactly the same with these waste treatment units. You can move them from site to site and hire them out over a number of years. Bottom right, our specialist division, fit-out, Interspace did the fit-out, and Almanjara Norco did all the joinery for that. Almanjara and Norco's workload is starting to show signs of picking up quite nicely. That was just a quick flavour of our construction work. Right. Support services international. So we've got two principal areas of operation. We look at it slightly differently to the UK. Engineering and facilities services. Basically, engineering is everything in the sort of petrochem and process industry. And our facility side is basically everything else, everything that people use and live in. As I said, we're making quite reasonable margins in these two businesses, albeit that the facility services side is still quite small. And our strategy is to grow them both, to increase equity, take a majority where we can, adopt a more region than country-centric operating model, and increase the prominence of Interserve branding. And this is actually quite different to the construction businesses, where we're actually working for IOCs, international oil companies, and related entities, who really want us to work where they work. So they want to carry a recognised partner with them wherever they go. So we need to change the way that we present ourselves. So we've got a strategy for doing that, and the acquisition of TOCO was a step towards that strategy. We've also brought a senior team of directors across from the UK to work as part of our international team to develop our facilities services side as well, and I'll talk about that in a minute. We are supporting those businesses from our existing associates, so that gives us a good platform to grow away from. But we're also looking for suitable acquisitions and investments in the UAE and Oman and KSA, where we think there's good opportunities for growth. I thought you'd ask the question about oil demand and was that going to impact on our plans, on the economies over there and our plans. This is an OPEC chart which plots the change in demand for oil through to 2035. And yes, we are seeing a decline in demand in Europe and America, amounting to about 5 million barrels of oil per day. But that is more than balanced by an increase in demand in India, China, and the rest of Asia, and sort of growing the other growing economies. So it goes from about a production of 105 million barrels today to about 130 million barrels in 2035. So we're going to need more oil. In terms of project spend in the oil and gas sector, 2010 to 12, $75 billion. This is in our region, and that's going to triple over the next 3 years. And you can see where it's going to triple. You can see why we're looking at Oman, and we've acquired there. We're also looking at UAE, and we're going to need to seriously, I mean, if Iraq can get its projects off the ground, we're going to have to seriously look at that too. Now, what I would say is you will note actually that there's a reduction in spend between Qatar on the left and the right, but actually a lot of that infrastructure's in place, and we're already there servicing that infrastructure. That is our space, and I'll explain where our space is in a minute. Where's the oil and gas? Some of you may already have seen this. The blue is oil, the red is gas, and you can see that Qatar is virtually floating on it. We were telling the story, they were telling the story that a couple of years ago that they had a 100 years supply, and they found since a gas field underneath that one, which is just as big, and now they're talking about having a 330-year supply of gas sat underneath Qatar. Their gas production is set to rise from about 107 to 180 billion cubic meters per annum up to 2019. Oman is also starting. Oman barely shows on this actually. It's kind of down here. It goes off the bottom of the map. Their oil and gas is a little bit more difficult to get out, and I'll talk about that in a minute. But they're looking at increasing production. That's a key generator of revenue for the government. And Abu Dhabi are looking at increasing production from about 2.6 to 3.5 million barrels per day, as well as gas. They're going from 50 billion cubic meters to 120 billion cubic meters over the same period. So where do we sit? We've kind of borrowed this chart. Across the top there, you've got the field development. So you've got the surveying, the drilling off to the left, field development, operations, and then decommissioning. And down the side, you've got the oil companies, national and international oil companies, main contractors, system integrators, product suppliers. Now, we occupy the space kind of bottom and middle, which is fabrication and package subcontracts, electrical instrumentation and testing, mechanical equipment, maintenance and modifications, now logistics and transport, and well services. Now, we did everything in the green with Medina, and there was some crossover with TOCO, but they operate in different geographical areas, so it was a good fit. We understood exactly what we were buying, which was good. But they also do some different stuff as well, and there's an opportunity to cross-fertilise those services between those two businesses, and further as we expand this engineering business. What we don't do is exploration and drilling, large EPC projects, operation and decommissioning. So, acquisition of TOCO. You'll all have seen the announcement. We bought it for $40 million at the beginning of the year. We've got majority ownership, and we've brought in our existing local partner, Maqbool Hamid, with a minority interest, so that we can control what's going on and we can leverage it into other geographies at will. Onshore engineering, Medina do some offshore, so there's an opportunity because Oman is going offshore. Procurement, construction, they do some EPC work, shutdowns and maintenance, and rig movement, fabrication, pipeline maintenance, which again are new competences to our business. Customers, PDO, which is the state oil company, Oxy, Shell, and Oman Liquid Natural Gas. There are competitors in the country, Galfar, probably the biggest, STS, and Arabian Engineering. Now, Oman's going to invest over the next 3 years 25 billion into oil and gas infrastructure, so we're going to be targeting some of that. Operating bases, they have 5, the head office and logistics base in Muscat. SUR, where they provide services to Oman liquid natural gas, Fahud, Safa, and Makaisner down in the south. So they've got a good spread of bases. Just some pictorial representations of sort of who they are and what they do. Top middle is a picture of some of the guys in the Makaisner oil field, and sort of top right is the base we operate out of there. They all get into those Canter trucks every morning, go out into the oil fields and put new pipelines, maintain the wellheads, the steam plant, and all the sort of process equipment. The picture in the centre there's a pipeline going in. These are side booms. They're all owned by the company. Bottom left there is a rig movement going on. Now that is the tractor unit pulling this oil rig to its next station. So these are massive things. And that's the construction of a plant down in Makaisner. These are some of the columns starting to be lifted in. So that's a sort of flavour of the kind of work that they do. And whilst we were in the process of acquiring TOCO, we had the opportunity to get involved in a bid that was going in the north of Oman. And very much get our hands on how we bid that. So on the 2nd of April 2013, we were actually awarded that contract, which is absolutely fantastic, and pretty much fills up their order book for the next. Well, it adds to their forward order book for the next 3 years. Scope of work, very much work that's familiar to them, pipelines, flow lines, plant piping, fabrication, installation. You can read it all. Installation of equipment, hot tapping. Hot tapping is basically putting a new line into an existing live oil or gas main. Installation, paint and coating, civil and structure. Now, there's also a sister contract coming out to this for the civils works, for the main civils works. And our existing construction company is bidding that. And we're looking at how we can exploit the synergies between the two businesses to give us a competitive advantage and see that we can win both of them. That's a wellhead. These wells are amazing because the oil is a bit more difficult to get out in Oman, so they have to inject steam. These wells are probably only about 50 or 60 metres apart. And they drill a main tap down and then put steam points in all around it, so or radiating around these well points are steam injection, and that's how they sort of loosen the oil and gas up and get it up to ground level. So the other side of the support services business, what I'm calling facility services, so that's hard and soft services. They're currently delivered through the Kansab Group and How United Services. Turnover quite small at the moment, about £13 million equivalent per annum. But we're demonstrating that margins of 10% and above are deliverable at site. So what we need to do is grow the volume there. And we're pretty much operating, albeit some of these are single contracts at the moment, in all the sectors that Interserve can demonstrate capability. And so residential, education, hospitality, industrial, retail, health, defence and commercial. Now we're going to focus on growth not only through organic means, but also supporting new startups and through acquisition. As I said earlier, that is being supported from Group Centre, and also we're getting bid support from Phil's team in the UK for strategic bids. And we're aiming to register majority-owned businesses in Oman and Saudi this year. And of course, it all, yeah, anyway. Right, so this really is a diagram that is conceptual. So if you look at the sort of range of facility services that we do offer across the group, where we've got experience and track record that we can leverage in the UK and Europe pretty much across the breadth of all those services. We've already established hard FM and sort of discretionary building property services capabilities in the UAE and Oman and Qatar. And what we've got to go at, if I can get there, is all the stuff in yellow. So there's a lot to do in terms of broadening the services that we provide as well as the size of the business. Next steps. The green ticks represent where we're already established in the Middle East. So construction, we've got capability in UAE, Oman and Qatar already. Engineering, UK, obviously, Oman and Qatar, and we want to look at the UAE. Facility services, albeit we're operating at quite a low level, we're established in all three countries. We're going to establish in Saudi this year, and we're on the lookout for suitable acquisitions in UAE, Oman and Saudi. And we're also looking into frontline services. There's a big need to get Omanis, Saudis and Emiratis into the workforce. And that requires training and education in work skills, in English, and it's something that we believe we can use our existing training presence in the region to help deliver, and our competencies that have recently been acquired in the UK. And we've got a member of the investments team over there looking at quasi-PPP and PPP projects, and there's some good opportunities, we think, in the UAE, Oman, and Qatar in the private education sector. Qatar doesn't particularly need PPP. They're doing some water, but that's particularly private education. So, in summary, the recovery in construction is coming. It's visible in Dubai. We will maintain our position. We'll maintain our size and capability and position ourselves to take advantage of the upswing. And construction will continue to be a major part of our overseas business. We are treating the expansion of support services, that's engineering and facility services, as a strategic priority. And we want to become a significant player in the region by 2015. And that will help us to develop a more balanced portfolio of services. We'll also be looking into new markets where we believe opportunities exist at acceptable risk and where we can bring value. And we're going to test the market appetite for investment offerings and frontline services. So I think that's me. And we're going to take questions after Ian presents.